asset decrease, credit. Finished goods to work in progress. Right? So when the goods are sold, so that amount will go to how? Because cost of goods sold expense increase and cost of goods sold decrease, which is asset decrease being credit. So entry would be cost of goods sold to finished goods. So whenever sale happens, there are going to be two entries. Number one, to account for sales done by marketing department or sales department, and one is in your inventory department. Because when the goods are sold, finished goods inventory is decreased because inventory is now converting from raw material to work in progress to finished goods to sales, right? So sales increase, finished goods decrease, and finished goods decrease with the value of sales amount? No, with the value of its own costs. So that's why we create cost of goods sold. Cost of goods sold is our expense. So cost of goods sold expense increase debit, asset decrease, finished goods credit to, then it would be finished to finished goods. Cost of goods sold to finished goods, right? On the other hand, when we record the sales, so we sell to our customers. If they pay us later, then we create customer. Account receivable is our asset increase, debit. Sales belongs to owner's equity increase credit. So asset to owner's equity, which is debit to credit, which is account receivable to sales. If they pay us cash at the time of sale, then entry would be cash to sales, right? So whenever there are like, when the same sale happen, two entries gonna be recorded. Number one is the inventory department, because finished goods are decreased from the cost. And on the other hand, the sales department, they increase the sales amount and they receive the cash accordingly, right? So that's why the inventory is converted into expense. So cost of goods sold to finished goods. On the other hand, sale happen, which is customer increase, sale increase as well. So if you understand all this stuff, now here's the time for you to have the breakout room activity. So all the knowledge, all the things that we just talked about, prepare a journal entry, post them into the T accounts. Yeah, that's it, I think. And then at the end, you compute the, product cost. Product cost is direct material, direct labor, and manufacturing overhead divided by number of units. That's it. So just take a picture here, and I am going to set up the breakout room activity. So for those who are watching this online, so please pause the video here, and I will be coming back after the breakout room activity. I'm just going to pause the recording here. Okay, guys, welcome back after the breakout room activity. So I have received your files. So for those who are watching the video, let's compare your answer. Here we go. So the first entry would be for raw material to accounts payable, because we purchased raw material. And then the raw material is transferred to work in progress and manufacturing overhead. Entry would be the work in progress to manufacturing overhead to raw material. And then the direct labor and indirect labor going to be accounting for, which is work in progress, manufacturing overhead to wages and salaries payable, total 180,000. Manufacturing overhead to accumulated depreciation. So because depreciation is also a part of manufacturing overhead, right? So we charge it to manufacturing overhead. So manufacturing overhead is going to be increased or debited by 75,000. And manufacturing overhead, other manufacturing expenses credited to accounts payable, the total are 62,000, right? The F part, which you feel a little bit difficult, so we just go through that we need to find out per unit machine hours. So the machine hour applied cost for 4.8 million on the basis of 240,000 machine hours. So per unit machine hour applied is 20. So for this job, 15,000 machine hours were applied, and also the actual machine hours are also used as 15,000 machine hours, right? So you multiply it with 20, you find out 300,000. So entry would be work in progress to manufacturing overhead, because this is applied, right? So that's why it is credited. So the next part is you need to close the work in progress into the finished goods. Entry would be finished goods to work in progress. But what is the amount here? So in order to find the amount, you draw the T account of work in progress. So find out where is the work in progress here. So work in progress is here, here, here. 3 entries. So work in progress is debited, debited, and debited again, 3. So debited against 32,000, 60,000, and 300,000. So the closing would be 592,000. So all this work in progress will move out to finished goods, right? So finished goods to work in progress. Now to calculate the unit cost, so we have the cost of total cost of finished goods 592,000, and the question says let me set aside the controls here. See, 16,000 custom made machine parts are going to be manufactured. So you just divide it with 16,000. Answer would be 37 per unit, right? So now you know how we calculate the per unit cost. Christine, Chandra, Ronnie, Min.
Yes.
Right? So this is how you can also, find out the per unit cost of your own business as well. Okay. Now let's talk about the under applied and over applied cost, which we already discussed. So that, many students, I personally feel that this learning objective 8 should be, covered in learning objective, before 7, so that, we can easily account for this one. But we have to follow the book order. That's why I explained over there, because many students, they raise the question, what if our applied is lower or above equal? So that's why I think I feel appropriate to discuss that concept in that session. So that's why I explained over there, so that you have, you are mentally ready for this one. So the difference between overhead applied to the work in progress and the actual overhead is referred to as under applied or over applied. I talked about that. It's really happened that your forecast is equal to your actual one, right? There are many variables which can fluctuate. Maybe the cost rises or something, strikes happen, whatsoever, transportation costs increased, or maybe the depreciation, you change the depreciation method and depreciation increased. So in that case, your estimated overhead or applied overhead may not be equal to actual overhead. In that case, you see under and over applied stuff. So we talked about that. What is under applied? Under applied overhead exists when amount of overhead applied to job during the period using predetermined overhead rate is less than the total amount of overhead actually incurred during the period. In under applied means when your actual is greater than your estimation, which means the actual manufacturing overhead is greater than estimated overhead, which is applied overhead, right? The opposite one would be the overhead applied, sorry, applied overhead when you overestimate it. So your applied manufacturing overhead is greater than the actual one. In that case, we see over applied overhead. Now what we have to do with this one, we talked about that. If it is over applied, If it is over applied or we overestimated, it means our cost is also overestimated. So we need to decrease that. So the difference between, the difference of over applied would be less from work in progress inventory, right? So in T account, you have the raw material here. I call this direct material. You have labor here. You have manufacturing overhead, which is applied. So if over applied, you need to decrease that one. How you can decrease? So this is debit, this is credit. So you write it down here. Over applied, right? If under applied means your actual is greater than your estimation. It means our cost, product cost is also under applied, underestimated, right? So we need to add, in that case, this is work in progress. So we would, so there's direct material here, direct labor. Come on. Wait a second. And here we have applied. We write it down here under. Oh, come on. I think no more space here, so I'm just gonna write it down. So you added here. Add on the debit side, the under applied one. If we can just, okay, no. Under applied. I cannot write it down because control is not letting me do that. Here, now I can write. So you write on the debit side of under applied. So it means when we have under applied, entry would be, we would be charging work in progress to manufacturing overhead. And because we are going to increase debit. If we are okay, I think I need to, in the case of over applied, it means we need to decrease the cost. It means we